The Federal Reserve today once again raised its benchmark interest rate, meaning all of us will soon pay more on major purchases.
It's a delicate balancing act, trying to slow inflation without stifling the economy.
Another month, another interest rate hike, with rates now the highest they've been since 2008. Borrowers now likely to pull back on major purchases.
Homes are going to be increasingly more so out of reach as mortgage rates rise, car loans rise, student loans, credit card rates.
The Federal Reserve today continuing a risky tightrope walk, making money harder to get without killing further growth.
It's very, very difficult. The goal is to raise interest rates and slow things down, but at the same time, without doing it so aggressively that it throws the economy into a recession.
Most economists agree it's a necessary step, but it's painful. A slower economy means fewer jobs, and current record low unemployment figures may soon start rising.
Just like if you're sick, you need to take your medicine. You don't want to take your medicine. You don't want to be unemployed. I certainly don't want to be unemployed. But if you don't, things can be significantly worse later on.
Still, there's no guarantee this rate hike will work. It'll slow the economy, but other outside factors could keep inflation rates stubbornly high.
We still have the lingering effects of the pandemic, along with the associated supply chain disruptions. We have the war in Ukraine, and we have people who for a couple of years stayed out of the labor force but are now looking to enter.
For consumers, a rate hike is a call to control their debt, pay off their loans and their credit cards, and those on the market for major investments may want to act quickly as more rate hikes could be on the horizon.
If you're thinking about buying a house, buying a car, and you're wanting to wait, thinking interest rates might come down, there's no crystal ball, but it's likely that that is not going to be the case for the next few years.
Now, people write doctoral theses on Fed rate hikes and what they mean. We tried to do it in 90 seconds. Not quite as thorough as one could be. The one bit of good news in all of this, if you've been saving money in a bank, a CD, anything like that, when interest rates go up, the interest rates that you get go up. Everywhere else you're getting clobbered, but there's that one tiny bit of good news for people who have been saving, not investing necessarily. You're soon going to get a little bit higher interest rate.
Some silver lining.